Hello, I'm Tai Hui, the Chief Market Strategist of Asia Pacific of J.P.Morgan Asset Management, and welcome to our series of videos discussing the economic and market outlook for 2022. Now, in our last two videos, we discussed the global economic and political outlook, inflation and the Fed's policy options. In this video, we will discuss overall asset allocation and investment strategy in equities and how to generate income. How should Asian investors allocate to equities, fixed income, and other assets? Since the global economy is still in either early or mid part of the economic cycle, risk assets such as equities and corporate credits are still expected to outperform on a risk-adjusted basis compared with more conservative assets such as fixed income and cash. Developed market central bank policy normalization should continue to nudge government bond yields higher. The short duration and high yield allocations in fixed income should help investors to manage duration risks while generating income in a recovering economy. Global high-yield corporate debt and selected emerging market fixed income would fit into this criteria. For equities, international diversification is still key. The emphasis can shift gradually from developed markets such as the US and Europe back towards China and Asia. China is still going through an economic slowdown brought by policy changes and regulatory reforms. These underlying conditions are not likely to change drastically in 2022, but Chinese equities' underperformance in 2021 has already factored in some of these challenges. Moreover, there are sectors such as decarbonization and import substitutions that can enjoy policy tailwinds. Rising vaccination rates in the rest of Asia should allow for a more sustained domestic recovery and potential for earning upgrades as governments in the region adopt their strategies to live with COVID. Now, what are the likely drivers of corporate earnings given higher costs? 2021 would mark the peak of corporate earnings growth following the COVID-induced earnings recessions in 2020. Even if the pace of earnings expansion is expected to slow down in 2022, earnings per share is still expected to grow between 5 to 10% around the world. In the US, an EPS growth of 9% will be broadly in line with the pre-pandemic long-term average. For Asia Pacific ex-Japan, EPS growth could actually come higher than the long-term average. That said, we would expect significant variations in earnings performance across different sectors. The ongoing recovery from COVID should support earnings recovery in consumer services. Supply chain disruptions should also ease gradually over time. This would reduce the cost of pressure for downstream businesses. Financial sector should continue to benefit from rising interest rates and recovery in broad economic activities. A key to solid earnings growth would be the ability for companies to protect their profit margin. In the US, margin expansion has played a key role in the 2021 earnings turnaround. Historically, it would be very challenging for S&P 500 to produce a positive earnings growth without positive contribution from profit margin. Finally, how to generate income in a low-yield environment. Now, searching for income is still seen as a popular theme for investors, but generating yield is no longer as easy as it used to be. Investors are still facing very low cash return and have been driven to seek better alternatives outside of traditional sources such as government bonds for more yields. Now, there are a number of asset classes that can deliver income in the current environment. For investors in need of steady income stream, high dividend generating equities along with higher yielding fixed income is a good compromise. The recent recovery in earnings is accompanied by the pickup in dividend growth. Even though earnings growth may have peaked for this cycle, rising earnings should allow for companies to continue to reward investors with dividend, especially in Asia Pacific and Europe. Yield from fixed income has historically been a big attraction for the asset class. While Chinese developers have been a concern for the emerging market high yield space, there's more to emerging market high yields than just one sector, which can be easily managed with careful selection. The rising yield environment will require a combination of short duration and high yield, ideally with additional hedge against duration risks. And investors should also remember the benefits of looking towards alternatives for yield sources. Alternatives can offer attractive yields while also possessing low correlation with equity markets and lower sensitivity to interest rates compared to fixed income. including alternatives as a source of income and diversification for portfolio holdings could be very beneficial when market concerns over interest rate movements and economic recovery are high. Thanks for watching. We wish you a healthy 2022 and also a successful year when it comes to investing. Now, if you want to get our latest copy of our 2022 year ahead, please reach out to your J.P.Morgan Asset Management client advisors.